Hi there friends, it's your host Dogmaster, back with you as always. Today we're diving into trading using the triangle pattern, so let's jump right in. Let's cover some theory first and then we'll show you how to trade using this pattern. A triangle is a chart pattern that can appear on any time frame and is easy to spot. It consists of several candlesticks within two converging lines of support and resistance, forming a triangle on the chart. These patterns indicate the continuation of either a bullish or bearish trend. The triangle is famous for its high probability of a breakout, making it a great pattern with which to experiment. There are three types of triangles: ascending, descending, and symmetrical. Each signals a strong likelihood of a trend breakout. A triangle is a figure that in 95% of cases is formed as an accumulation zone for trend continuation. Only after a long fall, when the market falls by 20 to 30%, a triangle can reverse the global trend. The figure guarantee depends on the value of the previous decline or growth momentum. In the case of an equilateral triangle, when there is no obvious trend, it will be the value of the largest candle of the triangle. Now let's get to the most exciting part: trading. We've selected the Bitcoin USDT chart. Let's identify the triangle pattern. Triangles are easy to find on a chart because it's sandwiched between two support or resistance lines and compressed like a spring, building up the potential before firing. Our goal is to pinpoint the level when the market holds the price. In the main trader workspace trading view, which is integrated with the chart of any exchange, there are three ways to mark a triangle. Number 1. Draw a support and resistance line through the trend line tool or the Alt+T hotkey. Number 2. Use the triangle tool. However, if the price is highly volatile, it will not always be convenient to build it this way. There is a third tool for this purpose. Number 3. Use the triangle template tool to add 4 points, marking the peaks of the triangle and the price line on the chart. Here we have an ascending triangle which shows both the support and resistance levels. We'll draw lines through the highs and lows. Now let's consider where the price will go next. We can see the resistance level pressing down on the price and the support level below. Looking at the triangle, we can predict that the price will likely move upwards. The key takeaway is that the triangle usually breaks out on the fifth bounce. They are usually named A, B, C, D, E, so it's best to wait for the price to go beyond one of the resistance lines and trade at that moment. The support level is holding strong and volumes are high, indicating that we're likely to see a breakout to the upside in most cases. The most reliable triangle occurs when both our highs and lows are narrowing. If the range widens, the triangle becomes unstable and you must avoid trading. Let's wrap up the results. The triangle is one of the most versatile tools available. It can be spotted in any time frame and in various markets, making it accessible even for beginners. The breakout typically happens in a triangle on or after the fifth touch. However, triangles often produce false breakouts, so it's crucial to enter during the rise or fall and test the trade carefully. But even so, the triangle is considered one of the most reliable patterns, and it's usually the first one beginners learn. Hope you've mastered using triangles in trading. If not, make sure to rewatch this video. Thanks for tuning in, friends.